Welcome to this explainer. Today, we're looking at a massive, unfolding contradiction in the global silver market as of right now, July 7th, 2026. It's this wild story of extreme highs, absolutely devastating lows, and a systemic shift that's happening right beneath the surface of global finance. I mean, how exactly did a precious metal get ripped away from the public and essentially hoarded by the banks? Well, let's dive into it. We're talking about a negative 50% drop. Over the last 5 months, from January to July 2026, silver prices literally crashed by half. And this wasn't just some standard market dip, right? It was a brutal halving of value, right on the heels of euphoric all-time highs. A collapse of this magnitude in a major global commodity disrupts the whole shebang, from global economic stability down to the actual cost of green energy and tech. But to really understand why the floor fell out, we've got to uncover a pretty bizarre series of events happening concurrently over in the banking sector. And that brings us to the central mystery of our explainer today. On one side, you have ordinary people being aggressively forced out of the precious metals market by the very institutions that govern it. On the other side, the government is accumulating these exact same metals at an absolutely unprecedented pace. These are not separate, isolated incidents. They are two sides of the exact same story. So, here's our roadmap to unpack this. We're going to cover the retail silver lockout, break down the anatomy of the crash, examine the central bank contradiction, and then reveal a hidden supply squeeze. Finally, we'll wrap up with industrial demand deficits and analyze what actually happens next. Section 1. The Retail Silver Lockout. Let's start with the massive shockwave that hit the global market on June 25th, 2026. On that day, ICBC, which is the largest bank on the planet by total assets, announced that retail precious metals trading accounts were permanently closing by July 24th. Postal Savings Bank, Ping An Bank, and China Guangfa Bank immediately followed suit. So why exactly did they pull the plug? It all traces back to the sudden collapse of an unregulated trading platform called JWR, where $1.4 billion just vanished into thin air when the platform simply couldn't meet redemption requests. For Chinese regulators, this sparked a terrifying wave of déjà vu. It was a dark reminder of April 2020, when retail investors holding leveraged oil contracts were completely and totally wiped out, as WTI crude famously went negative. To prevent another massive national scandal and essentially protect retail traders from themselves, the government acted swiftly. The infrastructure allowing retail leverage speculation is being completely dismantled. Section 2. Anatomy of a Crash. Because before this severe lockdown, the market was in a state of absolute, unchecked euphoria. The sheer volatility here is just breathtaking. Back in July 2025, silver was sitting comfortably around $29. By December, it crossed the $70 mark. Then, on January 1st, 2026, China implemented a silver wall, heavily restricting silver exports to just 44 state-approved companies. Squeezing that supply caused the market to absolutely explode. By January 29th, silver hit an all-time recorded history high of $121.62 per ounce. It felt entirely unstoppable. But today, it sits at exactly half that, $60. So how on earth did a runaway train just stop dead in its tracks? Well, the answer lies in the brutal mechanics of leverage and liquidity. Literally, one single day after that all-time high, the CME Group raised margin requirements on silver futures. This immediately forced leveraged traders who didn't have enough cash on hand into automatic, cascading liquidations. Over in China, Guangfa Bank took it even further, hiking retail margins to an impossible 140%. I mean, let that sink in for a second. That means for every dollar of silver you want to trade, you needed $1.40 in collateral. It was mathematically designed to force people out of the market. And compounding this massive sell-off is silver's dual identity. When the Federal Reserve signals hawkish policies, meaning they might keep interest rates high to fight inflation, silver gets hit hard as a monetary asset. At the exact same time, those rate hike fears weaken its outlook as an industrial metal. It was basically a perfect storm. Section 3. The Central Bank Contradiction. Now we arrive at the most glaring, unexplainable anomaly of 2026. The contradiction here is stark. On one hand, retail investors are being forcibly locked out of the metals market. On the other, the People's Bank of China is buying gold at a blistering pace, adding nearly 10 tons in May 2026 alone. This marks 19 consecutive months of government accumulation. To put that in perspective, in just the first 5 months of 2026, Chinese gold imports reached an astounding 692 tons. That's a 76% year-over-year increase. The government's regulatory actions effectively designed a retail exit, which in turn suppressed prices and created a drastically cheaper entry point for itself. The PBOC is quietly building a massive physical reserve inside its own borders, creating a war chest that is entirely immune to Western financial sanctions. Section 4. The hidden supply squeeze. Because while everyone was distracted by plunging price charts and locked accounts, a major lever was pulled in the physical supply chain that most mainstream analysts completely missed. It's fascinating how interconnected global commodities are. I mean, who knew a chemical ban in China could choke off silver in the West? In May 2026, China banned the export of sulfuric acid. Why does this matter for precious metals? Because 70% of all newly mined silver is actually a byproduct of mining other metals, primarily copper. Chile, which is the world's largest copper producer, relies heavily on a process called heap leaching. This essentially washes the mined rock with massive amounts of that Chinese sulfuric acid to extract the metals hidden inside. With Chilean buyers unhedged and cut off from acid for the second half of 2026, their copper output will significantly slow down. It's like a giant puzzle where dropping copper output quietly and dramatically cuts off the physical silver pipeline to the rest of the world. Section 5. Industrial demand and deficits. And this silent supply squeeze is happening against a backdrop of historic structural shortages. The Silver Institute confirms that 2026 marks the 6th consecutive year where global silver demand exceeds the amount of silver actually being mined. Since 2021, over 760 million ounces have been drained from above-ground stockpiles. The industrial drain is massive, and it's growing. Solar panels alone now consume 29% of total global silver demand, up from just 11% a decade ago. Add in electric vehicles, which require 25 to 50 grams of silver each, and the massive AI infrastructure build-out. This is incredible to think about, meaning your next heavy AI prompts might literally rely on silver sitting in a data center server somewhere. This is demand that simply cannot be substituted with other materials. And the institutional smart money clearly sees this deficit. Notice the incredible irony here. While retail traders were completely wiped out and locked out of the market, JP Morgan, the largest U.S. bank, which bet against silver for years, quietly closed its short positions. Instead of betting against it, they flipped the script and have reportedly accumulated nearly 750 million ounces of physical silver. Their base case price target for silver in 2026 now sits at $81. Institutional money is feasting on the remains and hoarding the physical asset right as retail leverage is cleared from the board. Section 6. What happens next? Let's take all of this context and look at the technical reality. We really need to talk about the gold to silver ratio. Right now, it sits at 68. This means it takes exactly 68 ounces of silver to buy 1 single ounce of gold, which puts us right at the 50-year historical average. But here is the absolutely crucial detail. In maturing precious metal bull cycles, like the ones we saw in the 1970s, in 2010, and again in 2020, this ratio typically compresses down to about 40. Now let's do the math on that. With gold currently trading around $4,100 an ounce, a ratio compression down to 40 would imply a fundamental silver price of $102. Let's translate these fundamentals into the actual technical levels professional traders are watching right now. We are currently sitting at the $60 support zone, which directly aligns with the all-important 200-day moving average. If the market breaks below this, the next real floor of support is the $54 to $55 zone. Below that is the $50 mark, which served as the historic 13-year breakout floor. To the upside, getting back through the $71 to $72 range is what would technically confirm the correction is finally over, and the bull market has resumed. And all of this hinges heavily on U.S. macroeconomic data. For instance, the recent weak June jobs report severely dropped the probability of a September Fed rate hike. That's a scenario that structurally favors a weaker dollar and, historically, drives much higher silver prices. So the underlying physical supply is tightening globally. The central bank keeps hoarding at record levels, and the speculative retail noise has been entirely, forcibly removed from the equation. So I leave you with this to consider. Was this retail clearing event actually a bearish crash? Or is it quietly setting up the most bullish fundamental launchpad of the decade? Does the $60 support hold as the ultimate base, or do we test 54 before this historic structural squeeze takes over? Thank you for joining me for this explainer. I hope this helped clear up the massive